What's going on, guys? This is Chandler Smith, and in today's video, I'm gonna explain what the 1% rule is and why you shouldn't use it. I'm also gonna show you how to look at the numbers on a property so you can know the right way to determine if you should pull the trigger on it. All that I ask you to do is hit that little like button one time. Now, not 1% of the time, we're gonna get into the 1% rule, but just smash that button one time. It's so rewarding. And with that being said, let's jump into things. All right, guys, for those of you that don't know me, my name's Chandler Smith, and I've been investing in real estate for the last 7 years. I currently own 99 units of rental real estate, and I love everything real estate investing. Now, in this video, I wanted to explain what the 1% rule is and why you should avoid it, because I've seen so many new investors get burned because they jump on board to buy a property because of the 1% rule, and then they get totally worked over. Now, if you don't know what the 1% rule is, essentially it's looking at the purchase price of a property and seeing if the rents in 1 month equal 1% of that purchase price. So for example, if you've got a property that's worth $100,000 and that's what you pay for it to purchase it, then you need your rents to be $1,000 a month. Pretty simple, right? Yeah, it really is. And that's why so many people are drawn to this rule, because they find a property, they say, hey, it meets the rule, I'm gonna buy the property. The issue I have with this rule is so many new investors will find a property that meets that 1% criteria and they'll pull the trigger. They won't look at the quality of the property. They won't look at the actual numbers and expenses. They're just looking at the gross rents and the purchase price of the property, and they say, hey, it's a good property, let's jump on it. Well, here are the big problems you run into with that. First of all, the quality of the property matters. Second of all, a lot of people can manipulate the rents just in time to sell a property. I've seen so many people that will go in and even bribe their tenants to sign an agreement by paying them cash up front so they can raise the rents so it meets the 1% rule, even though that property won't consistently rent at that price. And so now you've purchased a property that's total crap, that the second this tenant's lease ends, you're totally screwed, because then rents are going to drop back down unless you bribe someone at the beginning, which is just the same as getting lower rent. So you're not going to be getting the return that you want. The other major issue I've run into, especially in certain markets, is that in some markets, taxes are extremely high. Insurance is extremely high. Other expenses are extremely high. And what this does is it totally changes the way that the numbers come out. So if taxes, insurance, and other things are low, the 1% rule can work, but it's only if those other things work. So for example, I've purchased properties that meet the 1% rule dead on, which means, hey, it met their criteria, you bought it, that must mean the 1% rule works. However, I've looked at properties in Texas that meet the 1% rule, and they barely cash flow because the taxes and the insurance are so extremely high. On top of that, there's so many things that go into the due diligence process, and so it is so essential that you know how to go through that entire process and you know exactly what you should look for. Now, I want to be clear here. I'm not saying the 1% rule is totally useless, because here's the deal. Once you know your market, you know where average taxes, average expenses, average insurance, where all of those things come in, you know what your interest rate's going to be on your loan, then you can get to a point where you can see a property and very quickly know, hey, in my area, the 1% rule is a good criteria. Or hey, in my percent rule, it's a 1.5% rule or a 2% rule. It totally depends on your market and where those expenses are going to end up. And once you've started looking at properties enough, then you can look at a property and say, wow, if it meets the 2% rule, I know it has to be a killer deal. Now, does that mean you skip due diligence? No, not at all. But what it will help you to do is you can look at the MLS, or you can know immediately when a property comes across your table that it is going to be a good deal or something at least putting in an immediate offer. Now, do I still think it's a good idea to just have one rule, like a 1% or a 1.5 or a 2% rule, and that is your end all be all. No, I don't. However, if you're wanting to put in a quick offer and you know that number and you've got to get it done quick and you can get it under contract dependent on inspection and giving yourself a due diligence period, then yes, it's awesome to be able to use to, first of all, find the good deals when you're looking at a lot of deals, or to quickly know, hey, these numbers are extraordinary. It's worth at least putting in an offer. However, I would still say that you should do some quick math knowing all of the expenses. Now, you could still get into a property and find something in the property in the area that turns you way off. However, what I suggest doing to make sure you're even more confident in a deal before putting in an offer is going onto the App Store and downloading my app. Now, it's completely free. It's just CDS Rental Calculator. And what this calculator gives you is the ability to, on your phone in literally 60 seconds, be able to plug in the numbers and know if a deal works. And what I'm going to do in this video is I'm going to show you a very simple deal that does work, but a very not simple deal that the numbers are the same when it comes to purchase price and rents, but the expenses are different, so that you can see how drastically different these two deals are, how one would be worth buying and one would not be worth buying, even though their purchase price and their rents are exactly the same. So with that being said, I'm gonna grab my phone and I'm gonna open up this app. Now again, if you haven't downloaded it, it's on iOS and Android. Just plug in CDS Rental Calculator and you're completely good to go. I'll also put a link down in the description. So right off the bat, we're gonna do a very simple deal. So we're gonna make the purchase price $100,000. We're gonna make the down payment 25%, closing costs 2%, 30 years to pay off, and a 3.5% interest rate. Now in this property, we're gonna plug in $1,000 for rents. Now that perfectly meets your 1% rule, dead on, because the purchase price is $100,000. 1% of that is going to be $1,000, which is our monthly rent. Now we're gonna jump down and do a vacancy of 6%. We're gonna do maintenance at 12%, management at 7%, insurance at $250, and taxes at $850. Now, I'm sure there are a lot of you saying, Chandler, those seem extremely low. Well, here's the deal. I made up the numbers, and can you guess where the return's gonna come in at? Dead on at 15% cash on cash return. Now for me, I want to know that my cash on cash return is 15% or higher. Now, did I make these numbers come in perfectly so that I could prove a point? I did, but these numbers are going to give you a 15% cash on cash return. But as I'm sure some of you are thinking, well, those taxes sounded really low, or that insurance sounded low, or those expenses maybe even sounded low. If you're thinking that, then the 1% rule doesn't work in your market. And that's why I did this video, is I want you to understand that the 1% rule might work in a couple markets, but I am telling you, with where taxes are, with insurance, with other expenses, the 1% rule doesn't really work anymore. It's a great thing to use to look at properties just from the beginning. But then when you dive into the numbers, you'll find that a lot of properties that meet the 1% rule aren't going to work. However, this one that we just ran the numbers on, it works perfectly. Now, if you don't know what a cash on cash return is, essentially it's taking your initial investment and determining what your yearly return is on that initial investment. Now, my initial investment is just my closing costs and my down payment, and that shows me that I'm getting a cash flow of $3,995, which ends up being a 15.08% return on my initial investment. Now, here's the deal. Again, these numbers were made up, but they're to prove a point. Right here, the 1% rule works. However, if we jump back and we're gonna leave everything else the same, so $100,000 purchase price, 25% down payment, 2% closing costs, 30 years to pay off, 3.5% interest rate, $1,000 in rents, 6% vacancy, but now we're gonna start tweaking things. We're gonna say that your maintenance is actually 15%. We're also gonna say that your insurance is $450 and that your taxes are $1,500, all right? We're also going to add in that you've got an additional expense of utilities that you have to cover that end up being a total of $500 a year. Now, these things might not seem that crazy, all right? I think those numbers are actually pretty realistic for a property that is going for $100,000 in certain markets. And in some markets, those expenses might even be low. But just those tweaks of making your maintenance 15%, your additional expenses, adding in that $500, your insurance at $450, and your taxes at $1,500, if we click run the numbers, you can see that your cash on cash return has gone from a 15% all the way down to an 8.71%. That means your cash flow is only $2,300 on the entire year. So you've dropped over $1,000 in cash flow, obviously because you added that into your expenses. So you can see, even though the property meets the 1% rule, you are not in a place where the 1% rule means this is a property that you should buy or that I would buy. Now, if a lot of you are saying, well, Chandler, how do I know what my rule is so I can look at a property quickly and know what the rents should be? Well, this is what's cool about this app, is if you go back and we're gonna go and look at this property again, what you can see is that we've got the purchase price at $100,000 and you've got your rents at $1,000. If you wanna know where it's gonna be, let's say that you up rents to $1,100. Now, this is simple math because it's out of $100,000. So obviously going from 1,000 up to 1,100 is just gonna bring you up to a 1.1% rule. But if you're dealing with a bigger purchase price, all you've gotta do is take your rents and divide them by your purchase price, and that will give you the rule that you need to play with. Now, is this rule essential for you to be able to invest in real estate? No, it's just something that you can use when you're scanning through lots of properties to see if it's something that you should even look into. And even with the 1% rule, it's the same way. This is a rule to help you scan properties so you're not wasting your time with one that is way off track. I mean, if you go look at a property that has $1,000 rents and it's a $200,000 property, you know without even going in and running all the numbers that it's nowhere near to being something worth buying. And that is why the 1% rule was created. However, I see so many investors that say, oh, Chandler, I used the 1% rule. I found a property that meets the criteria. I bought it. And I'm like, dude, did you look at the actual numbers though? Did you do any due diligence where you ran through all these other things? Because the expenses will drastically change those numbers. So even if you go in and we're gonna see, we plugged in 1,100, when you click run the numbers, that's going to put you at a 12% cash on cash return. So if we go back and now we're going to run the numbers at 1,200, that's going to give you a 15.35% return. So if you're a newbie investor, the only reason you should go and do this is after looking at multiple properties and saying, oh, we would need the rents at this to make it worth buying. You'll start to find that in a market, usually your taxes and your insurance and your expenses are pretty consistent. So after looking at lots of properties where you run all of the numbers on every property, you can get to the point where you say, man, all of these properties would have been a good deal at a 1.3% rule or a 1.2% rule. And then you can get to the point where you look at a property and you see the purchase price and you see the rents and you plug it in and you say, hey, this is a property worth doing all the numbers so I can see where the actual return is. This is a property worth putting in an offer, or at least putting in more interest to see if I should put in an offer. Now, the biggest thing I wanted you to get out of this video is that the 1% rule isn't the end all be all. Now, is it a good tip or trick to know what rule works in your market so that you can scan through properties and know which properties are worth taking the time to then run the numbers on and see if they meet your criteria? 100%. And if 1% works in your market, then yes, it's a great initial criteria. But then you need to do a deeper dive if a property is something that you're serious about before putting in an offer. Once you know the numbers look good on that deeper dive, and then you put in an offer and you get your offer accepted, then you need to do a lot more of due diligence. And I'm gonna talk about due diligence in a future video, but understand, just because you've used my app and you've run the numbers and things look good, that does not mean you're done. That does not mean that the property is ready to purchase. It just means that it is more than worth putting in an offer. And if you get your offer accepted at the numbers that work, you're in a great place to dive into due diligence to make sure that your numbers and the property and everything else are perfect. And that's why you want to make sure that you do your offer dependent on an inspection so that you can dive into these numbers deeper. Now, I'm hoping this video helps you understand understand why I don't like the 1% rule, but why I also do like the 1% rule. All right, there's a time and place for this rule, but don't abuse it and end up in a property that you're going to regret. Now, if you guys enjoyed the video, please make sure you hit the like button, subscribe to the channel, and I look forward to seeing you in my future videos where my goal is to help you to build a huge passive income. Thanks so much, guys. Have a great day.